Thank you, Marty, and hi everyone from London. I hope you can see me and hear me well. I'm going to share the screen, and as we discuss a few of these ideas. And yeah, I'll start by briefly introducing myself. I'm originally from Spain. I'm a mining and petroleum engineer. Did my master's in mineral economics at the Colorado School of Mines in Golden and the French Institute of Petroleum. And I spent the last 27 years in markets across some industry leaders like JP Morgan, Goldman Sachs, Merrill Lynch, but also on the sell side with recognized players like Brookfield Capital or Diamond Asia, amongst others. I've written a couple of books, a bestseller in the energy markets called The Energy World is Flat, a second book called The Anti-Bubbles, which I will discuss some of the key ideas today that are quite relevant and touch in with the macro environment. And in addition to my experience on the buy and sell side and the books, I'm also a visiting lecturer at Imperial College in London, where I teach at the business school on advanced trading strategies. With that, maybe let's start with the concept of anti-bubble, and which I think is quite relevant. And if we borrow George Soros' definition of bubbles, he would talk about bubbles as assets that are effectively artificially expensive based on a belief that happens to be false, what he calls a misconception. What I did is I generalized the framework and said, well, misconceptions can distort reality, but not only through artificially high valuations, we can also have artificially low valuations. So the first idea of or dimension of the concept of anti-bubble is assets that are grossly artificially cheap based on a misconception. The result is a matter of when, not if, that they will explode higher. And they could be viewed as some sort of extreme value investment. The second dimension of the concept is that bubbles and anti-bubbles are like distorted mirror images of each other. They're effectively two reflections of the same process. And by design, the moment the bubble implodes is the same moment that the anti-bubble explodes. And therefore, I called it anti-bubble, a bit like an antivirus or an anti-missile. It's a defense mechanism against the bubbles. And there's a third element, which is important, which is related to reflexivity, this idea of two-way causality, which effectively results in how bubbles and anti-bubbles feed on each other. And I would argue that one of the relationships that drives this bubble anti-bubble or that manifests itself is the relationship between equities like the S&P and the VIX and the volatility. We know that during periods of crisis, we tend to see equities collapsing, we tend to see volatility exploding. And then arguably on the other side, we have periods of extreme complacency, which can be driven with artificially low volatility levels. There are both qualitative and quantitative reasons that drive this relationship. Qualitatively, I would argue this idea that mommy and daddy have our back, that every time we have a problem, the central banks and the governments come to rescue us. Or quantitatively, as we see strategies like risk parity or vol targeting or trend following, which basically load up on the lower the volatility, the more leverage they get. These things tend to reverse as volatility changes. But what is really important about this framework is there's no good guy and bad guy in this movie. Sometimes equities are cheap, sometimes they're expensive, sometimes volatility is cheap, sometimes it's expensive. What's important is, ironically, financial protection tends to be cheapest when we need it the most. And that's, when you think about equities being at all-time highs, the market being extremely complacent, we tend to have these artificially low valuations for protective assets such as volatility. On the flip side, during the crisis, once things are already happening and equities and risk assets are highly distressed, there's a lot of people who panic and buy the protection. By that time, it's already too late. This is very much a counter-cyclical process where you have to embrace this relationship and accumulate and monetize on a counter-cyclical basis. Now, I'm Spanish, so I'm going to use a soccer or football analogy to describe, what I think it's very powerful, which is the idea that when we build a portfolio, it's really like a sports team. You're the coach. In this case, you guys are mainly family offices. You manage, your money, the family's money, or on behalf of the families. And you're the one who decides, what strategy we want to play and which players that we put on the field. And so in that sense, the framework and the white paper that I'll share with you today to present an alternative way to think about portfolio construction uses three key building blocks. The first one is the idea of what we call upside alpha, which is effectively the strikers in the team, the players that score the goals. They make money, right? They are, which they do in the form of capital gains and income and dividends. And they're generally equities and credit. These are players in your portfolio that will do well as the world does well. And they, the big difference between equities and credit, I would argue, is inflation. Whereas generally equities are going to be benefit more from inflation versus credit, where the $100 that you're going to get from whatever bond in 30 years are not going to buy you a piece of chewing gum. So in that sense, this conventional way of thinking about portfolio construction is not really about asset classes, it's about behavior. And here we're looking at effectively those players that will allow you to score goals. Now, who are the defenders, what we call downside alpha? And their role is really to preserve the capital, to protect the team. And this is true both in nominal terms as well as real terms, i.e. Inflation adjusted. Historically, fixed income government bonds have played this very important role of defending the portfolio. However, the gross manipulation of and distortion of monetary and fiscal policies, I would argue, has dramatically changed this relationship. And in fact, 2022 was perhaps a bit of a wake-up call to a number of people who were relying on fixed income as a defender, only to find themselves exposed to what we call hidden leverage and false diversification. Now, looking forward, I would argue that the change that Marty was referring to, in particular with tariffs, I would argue that it's a perfect storm for what we call cold drawdown risk, which is equity down, fixed income down, which is clearly the Achilles heels of global markets. The scenario when everything falls apart, and it can happen alongside with volatility. So 2022, whilst it was painful, I'd argue was a bit of a walk in the park because we didn't really have the big volatility moves. So in that sense, when your defenders fail, who comes to the rescue? And here we need effectively the goalkeepers. Who are the goalkeepers? Well, the anti-bubbles, in my opinion, assets like volatility or tail risk. And arguably, you don't really need the goalkeeper if your defenders are doing their job, but you better have one when they don't. And the third component of this portfolio construction is what we call rebalancing alpha, which is basically teamwork. Is how do the players pass the ball? How does the team work relative to the individual pieces? And it's a critical component and concept that I'll be discussing shortly. Before I move on there, I will just show you this slide, which I think illustrates very much the mechanics of a crisis. I call it Chronicle of a Crisis Foretold, in honor of Garcia Marquez and his book, because crises are really very mechanical in nature. And the starting point is you see two gray lines that are, seemingly low volatility and negatively correlated. So when you think about your portfolio, which is the blue line, you would think that my portfolio is very safe and I don't really have a lot of risk. Now let's look at the three key variables, and let's just shift volatility higher, leaving correlations unchanged. Math's a partial derivative. And what you see is that as volatility increases, but correlations stay negative, the portfolio risk doesn't really change much. In a way, the correlations are protecting you. And this is sort of the idea behind the 60-40 balanced portfolio. What happens, on the other hand, if we were to shock correlations from -1 to +1, leaving volatility unchanged? And what we see is that portfolio risk grows pretty much exponentially. What we take away from this very simple graph is that portfolio risk is significantly more sensitive to correlation than it is to volatility. However, what happens in practice is volatility and correlation tend to feed on each other. For those with the physics background, we have these processes where effectively the resonance principle in physics, where they feed on each other, and we can see effectively how risk goes literally off the charts and liquidity dries out. You might remember March 2022, and this is the kind of dynamics that appear and effectively lead to the risks of what we call false diversification and hidden leverage. So in that sense, we view these dynamics both as a risk to highlight how people can literally blow up through these risks in their portfolios, but also we see it as an opportunity to accumulate assets that actually are artificially cheap, and we can monetize during the crisis to accumulate, all those distressed assets. So before I move on into the white paper, I'm going to touch on some of the macro views from a very big picture perspective. This is my sort of contrarian framework of the anti-bubbles. And amongst others, I would argue that in the system, what are the question I asked myself when I wrote the book in 2017 was, okay, what are the beliefs in the system that are effectively false? They're misconceptions. And what are the bubbles and what are the anti-bubbles, and how do we take advantage of this? And perhaps, some of the biggest misconceptions in the system, in my view, is this idea that when we have a problem, we can solve it by printing money and taking debt. This idea that monetary policy and fiscal policy solve problems, which in my view is completely false. What we do is we're doing four things. The first thing is we are effectively kicking the can down the road. We're delaying the problems. It's an intergenerational issue. We're spending and borrowing our way out of trouble, and that's common practice across governments in particular. We are transferring the problems. For decades, we've seen how countries try to effectively print their way and devalue their way into having competitiveness. And you would think, I want to devalue my currency so I'm more competitive, and you're going to send me your money, your investment, your factories, your technology, your everything. And guess what? The trade wars that we're seeing today is in a way a response to these kind of dynamics. You devalue by 20%, I'll tariff you by 20%. And what we're seeing today is historic, and it has deep consequences, particularly for those who have been abusing, in my opinion, the monetary side of things, because they're going to be left with the problems without the benefits. The third thing that's happening is we are transforming the problems. And you don't have to be a genius to realize that when you're printing trillions and trillions and trillions and trillions of dollars and euros and yen and yuan, you're effectively diluting the monetary base. It's not really that your house is going up. It's the value of the money you have, it's going down. And this, tax on cash, this creates, severe problems such as inequality, populism, social unrest, and of course, and unfortunately, war. So I would argue that a lot of the geopolitical stuff that we see is hard to pinpoint exactly, but there's a lot of it that goes through some of these major imbalances. For those who have a copy of my book, dedicated copy, I tend to say, I hope you like it. I hope I'm wrong, because I do feel a bit like a doctor diagnosing a terrible disease to a friend. As a friend, I want to be wrong. As a doctor, I want to be correct. And the last point I would make is that the monetary and fiscal policies without limits are enlarging the problems. It's not a zero-sum game. We're creating systemic bubbles that are too big to fail. We're creating, and we are very much from a game theory perspective, on our way to stagflation, which is effectively higher inflation without any growth. And so in the book, I would summarize the last decade as the transformation of risk-free interest into interest-free risk, with the stupidity of negative nominal yields in bonds and other things. And I think the next decade is going to be the transformation of bubbles too big to fail into stagflation. So in that sense, Voltaire, wisely reminded us, paper money eventually converges to its intrinsic value, which obviously is paper. And in some ways, we've seen all sorts of ways to kind of print our way out of the problem. When we think about borrowing our way out of the problem, watch out for this acronym called YCC, yield curve control. This effectively means that governments central banks, when you have governments that have effectively overextended themselves with too much debt, and you come to the markets, the famous bond vigilantes come to request, these higher yields, you're effectively sending the country into bankruptcy, as this spiral of higher yields that result in higher interest payments on your debt, and that means that you cannot spend in other things, and before you know it, all your money is going into paying that. And so what is happening already and what will continue to happen is central banks will step in and print dollars to basically buy those long-term bonds, keep the yields artificially low. We've seen this happen in Japan. We have it de facto in Europe with something called the anti-fragmentation tool. And central banks are well known for coming up with these funky acronyms and things that sound really clever, but all they're doing is they're just printing money to prevent the collapse of the system. And so what we're doing with yield curve control is transforming a credit problem into an inflation problem. And this sort of feeds back into this spiral of currency devaluations and explains in a large way what's happening worldwide. And bottom line is, we're kind of inflating our way out of the problem. I believe that we're all frogs in a monetary broth, where the official temperature is increasing at 2% per annum. That's complete and utter BS. Official inflation, it's first of all, my inflation is different from any one of yours inflations. It's not just a number. We have our own, and the goalpost keeps getting moved. And ultimately, I think the real inflation, the loss of purchase power, both pre and post taxes, it's one way. I would argue that inflation is a bit like the entropy of the universe. It only increases. So in that sense, when you think about the implications for portfolio construction, is think about who's financing this party, who are, and I would argue that people who hold cash and fixed income are effectively financing the party in the long term. This is the game that central banks and governments play. They make us believe, in this nominal game. And whilst the fixed income market now has earned a little bit of defensiveness with the higher yields and effectively the power of protecting through duration, I still think that in a 5, 10, 15, 20-year horizon, this is really the who are the people that are paying for the party is
Diego, can I just jump
through
in for a
inflation.
second?
Yes.
So if you go back to the prior slide on inflation,
Yes.
I would say that family office inflation is 10 to 20%, right? Because everything is, I mean, they've done studies that family office inflation, ultra high net worth inflation always runs higher than the average person's inflation. Cost of buying boats, maintaining expensive property. Actually, I had a guy whose house in Jupiter, Florida, went from 25 or 20 million to 50 million in the last 4 years in value. But he said also the cost of maintaining it probably had a greater increase, right? And actually, anybody who's ever had flood insurance in Florida knows what that's about, right? So I would say that the inflation numbers really matter a lot. And then the other part is that, which we really don't talk about, is that as assets become more and more inflated, the possibility of these, terrifying risks like a hurricane or things like that just goes off the charts. I mean, your valuation, your value of your assets can go from 100% to zero pretty quickly, right? So I think that's another thing that people don't discuss, because we've become, in the last 20 years, really an asset-oriented, at least in the United States, country. That's been the investment outlook rather than, income growth, et cetera. So
I agree with that, and I think we need to understand that it compounds exponentially. So, if you just think about, I think most of us in the room, I always say 20 years is not what it used to be, which some of you will understand. And 2%, for 20 years is 40%, even without compounding. So we've been stolen, really. If you actually factor in the compounded effect, and you look at the exponential impact that it has when it's not 2, it's 3 or 4 or 5, this thing just goes completely exponential. And the game that is being played is to create this perception, this fallacy that this thing is under control and keep us frogs. This is the reason why inflation has two sides. It has inflation itself, what I would call 2 + 2 = 4, and inflation expectations. And if you think about it, central banks, when inflation is low, central banks can do whatever they want, and they just doing. But when inflation expectations go up, this is the moment when they really panic, because it's the moment the frogs start to jump off the boiling water. So let's move on to the white paper, which introduces this idea of rebalancing alpha. And most of us will be familiar. When we build portfolios, we're really it's sort of a mathematical optimization exercise. How can I maximize my absolute return, minimize my risk and volatility? I do it through subject to certain constraints. But those of us that are in the investment world know that this is effectively down to what do I buy, how much, and when. And so this paper really talks about two types of mistakes. I would argue that very often we have errors of action. So we bought the wrong thing in the wrong size at the wrong time. But there's also very important errors of omission, which is I did not buy the right thing in the right time at the right size. And that's what this paper is a little bit about. So this framework of upside alpha, downside alpha, upside alpha, I'm going to break down in 3 very simple levels. Level 1 is, let's call it individual analysis. And what you see on the screen is basically the expected or the realized return versus the realized volatility of 2 assets, the S&P in blue and one of my defensive strategies in yellow. And what you see is that if you compare them on a standalone basis, you would see that obviously equity markets have done significantly better in terms of return with similar level of vol. So the size of the bubble is this Sharpe ratio. And if you were to ask to pick, obviously the blue dot looks great. In fact, the yellow doesn't look that interesting. Now, when we think about the Sharpe ratio, I just warned you, there's a few shortcomings. The first one is the industry tends to confuse volatility and risk. And when you look at Sharpe ratios, you're effectively penalizing volatility because it assumes if you're volatile, you're bad. My strategies made like 20% in a day during COVID. that type of volatility is not bad. Okay, what's bad is when you lose 20. Okay, so we need to differentiate between good vol, bad vol, and now thinking about that, and you're thinking about portfolio construction. Level one is our simple monkey brain says, oh, if I mix blue and yellow, I'm going to get that green, where effectively portfolio volatility and portfolio returns are linear. Now, let's go to level two. And level two is what happens, 1952, a gentleman called Harry Markowitz published a paper where he basically told us, hey guys, if you introduce correlation, what happens is you can actually reduce your portfolio volatility. But the small font that very few people understand is that your returns are still linear weighted average. So if I was to give $50 to two of you and you run the money separately, my volatility will be arguably lower than the individual pieces, but my return will be the average. And there's a number of big things that come out from Markowitz, this idea of the efficiency frontier that most of you are familiar with. But there's a very, very important concept here. And this happens to me all the time when I speak to like endowment CIOs or others. And they say, look, Diego, we're long-term thinker. We invest long-term. We don't really care about volatility. In some cases, they don't even need the liquidity. And ultimately, their utility function is, can I maximize absolute return? And if you do that, basically, the right answer is you just go all in equities. In some ways, the misconception is, hey, diversification is going to cost you money, because diversification is going to reduce the volatility, but it's also going to reduce your return. And so very often you find investors just going all in equities and not bothering about anything else. And this misconception, I'm going to prove it wrong in this paper. The other thing that Markowitz does is a little bit dangerous, is it tells you, why don't you buy this green low volatility point and lever me up, which leads to the blow-ups we discussed earlier. But ultimately, this is not about labels, it's about behavior. So let's move on to level three. And level three is what happens when you introduce rebalancing. What happens when, instead of just having passive portfolios, what happens when we take the pro-cyclical or counter-cyclical rebalancing ideas that effectively result in non-linearity and path dependency in portfolio returns. And what happens is, let's look at this real case. So in blue is equities, green are two portfolios like mix blue and yellow. And the difference between the dark green and the light green is the dark green is passive. So what you see at the bottom is that the drawdown during COVID, the market went down 20, let's say, my protection made me 20, and I'm like super happy because, I'm protecting my capital. But most people were like deers on the headlights. They were completely frozen by the crisis, like, oh, thanks God, I have my protection. But very few people actually said, oh, this is my chance. Let's monetize the protection, which, by the way, I bought in case these things happen. And I'm going to use that money to buy distressed assets. If you stay like the deer in the headlights, you're going to have the dark green, because what happens is the month after, as equities rebound and your protection goes down, yeah, you just stayed in that universe or where you had the benefit of lower volatility, but you didn't really take advantage of the opportunity. If you, on the other hand, are able to effectively monetize that protection through, and then the protection is the right parameters of convexity and certain things, then what happens is you're creating this new paradigm where effectively the exact same portfolio, just embracing that volatility, can create this incremental returns. And so what it means de facto is that when we think about portfolio construction, we should think about it as a non-linear game. It's not linear neither in terms of risk or volatility. And this is when you push it through extreme cases. This is when my brain exploded, okay? You build these models, you do all the analysis. For 27 years, I understand these concepts very clearly. And then suddenly I find myself with these events. I'm able to create what I called the heart-shaped efficiency frontier. What happens is that when you have events of tail risk or accidents and volatility, what we're able to do is, by introducing this element where you accumulate protection and you monetize it to effectively buy distressed assets and follow this process, we're able to generate a whole new universe of efficiency frontiers that effectively create these higher returns and lower risk. This is completely changing the game, completely changing and challenging these misconceptions. But the critical thing is that if you buy protection, you have to monetize it. If you do not monetize protection, then I would say don't buy it at all. Okay. There's obviously events and periods that it's the other way around. For years, you might be looking like an idiot, being prudent with protection, and ultimately this creates a lot of biases. But what we're saying here is that effectively, if you think about rebalancing alpha as a source of return, but also it's proven that basically a portfolio of blue and yellow can actually create a higher return with lower risk, and extremely important, without any leverage. This is extremely important. There's no leverage involved here. We're just effectively having the strikers, the goalkeepers passing the ball. Now, let's just go into maybe sport that you like more than soccer. Let's use the analogy of Formula One, which I think is very relevant. And think about equities as being the engine of your portfolio. They are the power. They give you the speed. And on the other hand, think about the downside alpha as your brakes, which basically are meant to slow you down and keep you safe. And think about the relationship between them as the rebalancing alpha, the benefit that you have. The big irony of Formula One and pretty much any sport is that the better your defense, the better the results. In the case of Formula One, the better the brakes, the safer and faster the car. And what happens here is the brakes allow you to go faster for longer. They allow you to avoid the accidents. And so this, our monkey brain would say, hey, Diego, if I buy something that slows me down, of course I will go slower. And the answer is no. By having the brakes in your car. So I would argue, and I'll use Michael Jordan for the last sporting analogy. Think about how many points Michael Jordan scored. 50 points per game. The Chicago Bulls were great. The question is, how about Dennis Rodman? How about the rebounds? How about the defenders? And the answer is, the better the rebounds, if you catch a defensive rebound, the other team has less chances to shot on goal. So of course, that's going to reduce your risk because the other team's going to score less. They don't get second and third chances. But on the other hand, every time you capture an offensive rebound and you give Michael Jordan a second chance, he's going to take it. So out of the 50 points scored by Michael Jordan, how many were scored or should be attributed to our defenders? And so when we calibrate the portfolios, we look at our objectives, we end up with this dynamic where if I was to ask you guys, blue line or green line, I think everyone would agree that the green portfolio looks better. But if I showed you now, how about blue or yellow? Most people would think, oh my God, yellow is terrible. In fact, it looks so bad that I would never buy yellow in my portfolio. And this is exactly the mistake, the act of omission that most people make. It's hard to believe with our monkey brain that in order to generate green, you need blue and yellow. And this non-linearity of portfolio construction effectively is summarized here in these 4 steps of how we build these portfolios. Finally, the final comments from a academic perspective, and I'll just finish the presentation and open for questions with a real strategy, is when you think about portfolio construction, you need to think about offense and defense. It's not a game of offense, and beware of playing with 11 strikers. You need both. You also need to calibrate to your objectives. You need to decide, what am I trying to achieve and how much should I be buying? But also when you think about, the when, you need to think about monetization, accumulation. Otherwise, this is a very inefficient portfolio. And so I run a strategy called Aqua, which basically does this principle. We buy equities, we buy protection, and we rebalance. And so together, blue and yellow create green. And this is what's happened, since last year. But this is what's happened versus the S&P. So what you see is, if you are invested in the S&P, you're in the blue line. The first half of the year, the car is driving nicely. There's no surprises. There's no accidents. And fine, if you have your brakes, maybe you're going a bit slower. But look at what happens in August. You know, as the market collapses, our protection kicks in, every car's crushed in the corner. We take the opportunity to monetize our protection, to buy equities and effectively lap everybody else and keep going in a way that in the last week, as the market collapses, we are again protecting the portfolio and accumulating on protection. This process and what we're bringing to the table is a strategy that, you know, if I ask you guys, I'd say, do you own any US equities? Yes or no? The answer is, would you rather be blue line or green line? This is a $1-for-$1. If you have $100 in the S&P, you can swap your blue $100 for green $100, where instead of just having the long equity and protected, we are effectively adding the protection and the rebalancing. This is what we specialize on. The strategy, good and bad news, is it's live for a while, but it's available for offshore investors. We don't really have a US onshore version of the fund. But I would encourage you, anyone who's interested in learning more about the white paper that I wrote or the strategy, to reach out to me or to Marty, and he can give the details. I think we have them in the. I'm happy to share with people after the discussion.
Thanks, Diego. This is a very rich presentation that you made. We have questions from the audience. I do have a question. Do you mix in any private strategies with public, or it's all just public equities?
It's all public because by design, rebalancing alpha needs liquidity. So effectively, the way I would think about it is you should have when you think about your wealth, you have your own operating businesses, your own stuff, which is generally liquid. And it really depends, you know, the other side is going to be more liquid. You know, the gentleman who spoke before, they have a law firm. I would say that if you're a law firm, you can probably take a lot of risk in your liquid portfolio because crises are good for them, okay? Now, if you happen to be a risk-on business that effectively would go out of business if the economy collapses, I think you need to have a very defensive liquid portfolio. And this is not something that the typical private banks do. They just sell you the same old. But I think it's very important to be, you know, if we mix this with the long-term view on inflation, I believe we, you know, sadly, if you're not in the market, you're out. And good luck getting back in. Because those very prudent bankers who are in cash, you know, for me, cash is like a striker in the bench. You know, you're waiting for the right opportunity to buy a striker. Now, if you're out of the market and tactically, or you're in cash or whatever, the chances are your cash is being diluted like crazy. You're missing out on your equity and you'll be stopped in. So sadly, my point is you have to be fully invested. I mean, think about our children trying to buy houses or whatever. Good luck to them, right? So this is a market where I think you have to be fully invested. You need to be in the market for the next 5, 10, 20 years. Equities will likely continue to go up, but beware of running those equities without protection. Because there's going to be big shocks.
Can you go back to the prior slide that you had on portfolio construction?
Sure. The football one, or
yeah, the prior slide on portfolio construction.
Yeah.
Yeah.
Let me just bring it up. Trying to bring the slide. Which one? The football team, or sorry?
Is the portfolio all U.S. stocks, or is it global equities? It's 100% U.S. equities. Okay, great.
This one is U.S. equities. Is run against the S&P. We have the ability to run European version or MSCI World. We run a very quantitative process. When you think about how do you defend the portfolio, how do you create what we call the most reliable reactive convexity per unit of cost and carry. Being a goalkeeper is not easy. It's a very complex game, and we do it in a way where we are option specialists. We buy protection, and yeah, you need to match the protection that you buy to the asset that you're trying to protect. So in this particular case, where the underlying long is the blue line, is the S&P, the protection it's a multi-asset, multi-maturity, multi-strategy, but it has to have, the reliable reactive convex protection against US equities to be able to generate this.
So that's great, Diego. And I think that people don't really account for liquidity risk enough in their investments. And it's caught the whole series of bonds. But I'm going to turn it over to Pierre Dupont, who has a question.
Diego, good morning or good afternoon. And thank you for presenting here today. I'm Pierre Dupont. Very simple question. You actually just kind of answered it, but there's a bigger answer. The success of this strategy depends upon, I think, a couple different things. And one of them would be aligning your sort of downside protection, your upside when things are down with the portfolio. And you've just talked about how you're doing that specifically here. But it's a more general question because everyone's portfolios are a little different. Obviously, if they come to you, this is the portfolio they would get. But how you know that alignment's going to work, that your downside protection will be good when things go badly. And the second question is, isn't there always an issue of timing? When do you trigger your downside protection and take that gain? And aren't those are the two reasons why this fails, it strikes me, in the general case. And I'm curious what you would say to that.
So, incredibly important questions. And I'd say, the first one is this strategy is designed purely for S&P. So if I looked at your portfolio and you said, look, I have 100 million and I run, 60 in equities and 40 whatever, and this is my piece in S&P, I would just tell you, look, the 20 million you run in S&P, I think they would be better off in green line than blue line. That's kind of the idea. The second question, and I'm trying to bring a different presentation that I use, where effectively the question on timing is super important. And what the answer is, I don't have a crystal ball. And basically what we do is we run a very systematic process of accumulation and monetization. So let me see if I can share a screen with a little bit of more details on what I mean, and you're going to see the maths and the rationale. But so basically, I'm just bringing it up, and the idea is as a quantitative process, you want to. The first point I would make is that we have a self-imposed risk limit where we only buy options. Okay. When you buy an option, what you see here is a put option and a call option. I do this because from a risk management perspective, I've seen people with $1 million of value at risk lose 50. This comes through, hidden leverage, through long shorts that blow up, through, every time I hear people saying I'm buying puts financed by calls, my spidey sense just goes crazy. It's like, dude, you're not financing anything. Your long puts, your short calls. So the idea of paying premium is critical, and it gives this very this risk profile. But the way this works, and don't be put off by the maths. In some ways, what you want to do is effectively design. Okay, if a goalkeeper, if Sharpe ratio is not a good way to express to define what good of a goalkeeper is. What is it? And we use this highly quantitative process that introduces these factors called reliability, reactivity, convexity, cost, carry, etc. Where if this was a video game, each individual trade would have trade-offs. The perfect goalkeeper would be a perfect hexagon, and you're going to create these opportunities that try to do things. But ultimately, going back to the kind of what we do on the convexity, you want something that on the way up potentially lags a little bit, and who knows, maybe can surprise because we have a bit of basis. But on the way down, the convexity of the protection is critical, because if you think about what happens in this crisis, if you were just long puts on the S&P, let's say market's down 10, they protect you by 10. Market's down 20, they protect you by 20. Then it's very hard to take off your protection and buy the market, because the minute you take your protection, you're naked. And who knows where the next 20% is going to be. So this is the main reason why most people tend to be, like deers in the headlights, and also they don't tend to have enough protection. But the idea behind convexity is that as the market goes down, this is like the protection in the car. If you crash at 50K, maybe the seatbelt's enough. But if you crash at 200 or 300K, you better have, everything you got, from airbag through sidebars through, everything. And so as this crisis get bigger, you need your protection to be bigger. And that's what convexity does. And the fact that when the market's down 10, I don't really care what happens next. I can systematically monetize my protection because I know that if the market goes up 10, I made my money. If the market goes down 10, I have more. And that creates this rebalancing alpha, this convexity. So your question is, we don't have a crystal ball. You need to create these portfolios that are effectively allowing you to embrace that volatility. And you need to do it in a systematic manner where emotionally, you're totally 100% unemotional. So I think we operate at our best when we are unemotional, and that's kind of the idea.
So a quick question. So what's your benchmark?
S&P.
S&P benchmark. Great. We have one last question here, Steve.
Yeah, Diego, thank you very much for your presentation. I wanted to ask a question that correlates to monetary, fiscal policy, tariffs, etc.
Yeah.
President of the United States has created a strategic business plan to address inflation and other problems with our economy, the debt, etc. Do you believe that the methodology that he is using is going to be effective, or is it a kick the can down approach in relation to the comment you made? And how would you restructure portfolios based on whether you think that would be successful or not?
Well, look, I think the tariffs are a perfect storm for a big crisis globally. I think it's hitting on three things. It's not going to reduce inflation, it's going to create inflation. It's going to reduce growth and economic activity, and it's going to create volatility. So, and as a result, it's going to reduce valuations, which all kicks in. I think a little bit like Mike Tyson, the famous philosopher, who everyone has a plan until they punch you in the face. I think all these guys have plans and things that they try to implement. And once these things start to go sour, they will always 100% of the times try to go and default back to more of the same, more printing and more debt. There's absolutely no question in my mind that every single crisis will be met with more of the same, more printing and more debt, and that we're heading into some sort of stagflation. Now, the level, if this was a video game, the level one was, can you make money in nominal terms? We used to play that game for the last couple of decades because inflation was negligible. Tell me who here was worried about inflation pre-COVID? Nobody. It wouldn't even feature. So you were trying to make your 2% and fixed income looked okay. We're now deeply in level two, which is, can you make money in real terms? Yeah, I made 3%, but inflation is 20. You actually lost 17. And the third level is, can you make money in real terms after taxes? And I think taxes, we'll see, but to me, things don't really add up. Taxes on the rich, and the US is incredibly unique, and the rest of the world, we're unfortunately more on the other side. But I think it's very, very difficult to marry these conflicting points that you raised. They want to reduce inflation. They also want to incentivize certain things. And I fear that even the uncertainty around what's happening is going to have a toll in investment, in economic activity. And I think they're playing with fire. How you position the portfolio, I would definitely be, protected. I still think you need to be invested. I think equities in the long term will do well, but I think protected equities, like the green line, will do better. I think fixed income has a little bit of juice in the short term, because, you know, if you think about just keeping things simple, a 10-year bond at, let's say, 4.5%, if yields went to zero, you can make 45% in capital gains. I really question will go back to zero in a world of high inflation. I really question it. I think 2% might be the new floor. And so, but if you have real assets and illiquid assets, you also have taxes. I think it's a tricky one, but ultimately you want to be, in my opinion, with portfolios that are long inflation, and i.e. benefit from higher inflation, including equities and real assets. But I think you need volatility and protection, because there's going to be like big moves, and you don't want to be caught wrong-footed. You don't buy protection because you're scared. You don't buy protection because, you know, of fear. You buy protection, and I buy protection out of greed. I want to buy the hell out of the distressed assets when they collapse. And the market is kind of ironically giving us the protection. Right now, we've been building and accumulating protection like crazy, you know, for long dated stuff and across the board. I think there's a great opportunity to embrace the stupidity and embrace volatility, but I don't have a crystal ball. I have no idea what will happen, but I think volatility, inflation, and risk are going to remain high.
Fantastic, Diego. Listen, great job. Thanks so much.